Well, joining me now with some ideas is Brij Khurana, fixed income portfolio manager at Wellington Management. Brij, I love talking fixed income, and we don't enough. So in the U.S., what's the right way to think about its role in portfolios right now with tariff worries and uncertainties over whether rates are going significantly lower anytime soon?
Yeah, the way I like to think about bond yields is actually look at the stock market in a lot of ways. So if you look at some of the performance of cyclical stocks relative to defensive stocks, to me, that's a really good leading indicator for the way bonds are going to trade. And what's been interesting to me in this market volatility we've seen is cyclical stocks have underperformed defensive stocks by almost 35%. And usually when you see that type of move, bond yields are actually moves a lot lower than we've seen thus far. Since the peak, bond yields have fallen about 40 basis points. But, I do think if the stock market is right in telling us that there's these worries about the cycle, that's an environment where bond yields can continue to fall and, to your question, really be a ballast in portfolios.
What about fixed income from other countries, given that there's a possibility now that they're going to have to spend more on defense, perhaps more supporting industries that are facing tariff stress from the U.S.? Yeah. What's that going to do to fixed income there?
So, I think that's a really good point. So why is there this disconnect between where bond yields are and what the stock market is telling you? I think it is largely what you're referring to, this idea that in Europe and other countries, they have to spend a lot more on defense. Those cycles have been very weak. And if they're improving economic cycles, that does speak to global yields moving higher in those countries. That being said, I do think there's a number of countries, small markets, countries like Australia, New Zealand, where bond yields are actually even higher than they are in the U.S. And if you hedge them back into dollars, you get even more incremental yield. And those economies are largely in recession or close to recessions already. And so, once again, I think if you're more global in your orientation when it comes to thinking about your bond allocation, that can really help drive returns and once again, be more of a ballast to the portfolio.
Munis make sense here for the tax equivalent yield?
I think there's a lot of changes going on. I know there's a question of whether or not that tax exemption is going to be in place, given the spending priorities of the Trump administration. So, it's more of a question mark, and I think that in that field, and I think that speaks to U.S. fixed income more broadly, right? Another reason that bond yields haven't reacted to what we're seeing in the cycle is we don't know the fiscal plans that are going to be out at Washington in the next 6 months, and so, is it going to be more spending? That's obviously not a good environment for bonds. If we continue to run 7%, 8% fiscal deficits, that's not a great environment. But if we are really talking about an environment where spending cuts materialize, that should be a good environment.